Hello and welcome. You're with me on the Global Reset on CNBC-TV18 Prime. This is the program where we try and examine the big picture and analyze the global forces that are reshaping our world. And there are, enough and more forces and enough news flow each and every day. Now, coming up over the next 30 minutes, we'll have two experts join us. So two insightful chats. Deepa Kumar of S&P Global Market Intelligence joins us in just a bit. After that, we'll also be speaking with Najib, Shah, former chairman of CBEC, a little later. Somebody, of course, who's also keeping a close tab on tariffs and, of course, the negotiations, etc., which are underway. Before all of that, let me just quickly give you a roundup of the global updates from last night over the weekend and, of course, on Friday as well. Big negative surprise coming in from the U.S. labor market. The July jobs report delivered a sobering reality check with a sharp slowdown in hiring. About 73,000 jobs added. That's the weakest monthly gain in over 2 years. Job growth in the U.S. slowed to an estimated 115,000 jobs, down from 147,000 jobs in June and far below last year's monthly average of 240,000. The unemployment rate has risen to about 4.2%, raising fresh concerns about the strength of the U.S. labor market. Remember, all of this, of course, even before the full effect of tariffs, etc., starts to show up in prices in a meaningful way in the U.S. Consequently, of course, market pricing of what the Fed will do is moved firmly towards rate cuts. 90% chance of a rate cut in September now. I mean, if you look at bond yields, big move. I mean, the two-year yield fell about 27 basis points on Friday. So the market's pricing in rate cuts very, very quickly after that labor market data. Meanwhile, U.S. President Donald Trump has fired the Commissioner of Labor Statistics. This is hours after the release of the July jobs report. In a post on Truth Social, Trump wrote, and I quote, "We need accurate jobs numbers. I have directed my team to fire this Biden political appointee immediately. She will be replaced with someone much more competent and qualified." End of quote. I mean, just shocking in more ways than one, but that's essentially what has happened. Of course, President Trump also put out another post saying that, well, Fed Chair Powell perhaps should take a lead and leave. This is not, of course, a new attack. He's maintained that for a while. In fact, he would President Trump said he would announce a new head of the labor statistics within 3 or 4 days. Listen in.
We'll be announcing a new statistician sometime over the next 3 or 4 days. We had no confidence. I mean, the numbers were ridiculous, what she announced, but that was just one negative number. All of the numbers seem to be great. And so we'll see how that comes out. And if you remember, just before the election, this woman came out with these phenomenal numbers on Biden's economy. Phenomenal numbers. And then right after the election, they announced that those numbers were wrong. And that's what they did the other day. So it's a scam, in my opinion. My opinion is it's just additional scam.
Okay, listen to Goldman Sachs's Han Hatzis on what he makes of the July jobs report what ahead for the labor market in the U.S., Fed pricing, etc.
I think it makes it even more likely that they're going to cut in September. We have had a series of 25 basis point cuts in September, October, December, and to me that seems very likely, and it could be more. I mean, it's certainly a reasonable idea that we're in restrictive territory, but these sort of data suggest maybe we should get back to neutral a little bit more quickly. We have that happening over a longer period of time, but you could accelerate the process.
Let me turn our attention, of course, to India-US trade talks. Remember, this 25% tariffs from the 7th of August is what we've last heard. And that did come as a bit of a shocker towards the end of last week. Deepa Kumar is, I think we'll have Deepa Kumar of S&P Global Market Intelligence in just a bit with us. But remember, market expectation still is that there will perhaps be something which will be worked out before the 7th of August. That is later this week, and India will be able to negotiate those 25% tariff rates a little lower. The sticky points of contention are, agriculture, access to agriculture, and a bunch of other things as well. But agriculture, of course, is the big sticky point, which has been the point of contention for a while now. What we'll do is, let me just quickly update you with some stories on the oil oil prices as well. And one big point of contention has been, the graphics will come up, one big point of contention has been the Trump administration asking India to buy more US energy, right? And that's been a sticking point, that the blame has been that India, with its purchases of Russian oil, is funding the war in Ukraine, Russia's war in Ukraine. So US wants India to buy more energy, be it oil, crude oil, or LNG from the US. Now, over the weekend, 8 members of the OPEC Plus announced another large output hike of 547,000 barrels per day for the month of September. This is the second straight increase. We saw a hike in the month of July and now in September. And this kind of partially reverses some of the cuts that OPEC Plus had effected in the year 2023. In a series of accelerated output hikes to regain market share, the OPEC Plus move marks a full and early reversal of the largest tranche of output cuts, plus a separate increase in output from the United Arab Emirates amounting to about 2.5 million barrels per day, or about 2.5% of world demand. Let's talk about oil in the context of what I was saying earlier, right? I mean, CNBC-TV18 learns that India's crude imports from the US will likely go up by over 150% this fiscal. In fact, for April to June quarter, imports amounted to $3.7 billion versus $1.7 billion same time last year. That's a jump of about 114%. India's crude imports from the US has risen from 3% to 8% in the month of July itself. Now, even as additional penalties that the US president has threatened to impose on India for doing business with Russia remains unclear, sources tell CNBC-TV18 that prices of crude oil are likely to go up if India stops sourcing crude from Russia. Sources now emphasizing on the significance of India buying Russian oil for price stability. From the 4.5 million barrels of Russian oil exported, 2 million barrels are sent to India. And important to note, of course, that Russia produces 9.5 million barrels per day, which is nearly 10% of the global oil demand. The last time similar fears of Russian oil going off the market had surfaced, prices of Brent crude internationally had spiked to $134 a barrel. This was, of course, back in March of 2022. So it's a tough, delicate balancing act for India with regards to, of course, what the US wants. Not everything can be done, but can we sort of give in to a reasonable degree without hurting our own interests? That's the question. I think we have Deepa Kumar, head of APAC Country Risk Head at S&P Global Market Intelligence. Deepa, good to have you with us here. Thank you very much for joining us.
Thank you, Prashant. Good to be here.
So how will this settle, in your opinion? So let's talk specifics, Deepa, if you can. Where do you think, do we, by the way, before the 7th of August, in your opinion, see something? Some sort of a, even a handshake deal? And will that 25% number come down?
So I think there are two parts to this, Prashant. One is, of course, what can be achieved before 7th August, which is not just that 25% tariff rate number, but there are other considerations for India here on Section 232 tariffs, which apply to pharma, electronics, auto, steel, and aluminum for India. If it comes to prior to 7th August, I would say, given that they have announced that the next negotiation is going to be on 25th August in New Delhi, I would say it is unlikely for us to reach some kind of announcement. But having said that, to your second question, right, is 25% tariffs are given? I would say more revision is likely, most likely to be a downward revision. We'll speak a little bit later, of course, about the regional competitiveness that India has and some of the other trade numbers, tariff numbers that India's peers in Asia Pacific have. All of those are numbers achieved after a deal has been signed. India's number is, of course, 1% lower than what was announced on April 2nd so far. But it's quite likely that that 25% tariff number does come down as and when we reach a stage for a deal getting finalized. But looks difficult before 7th August now that they themselves have signaled that 25th August is the next meeting.
Yeah, no, absolutely. I was talking about this oil bit, right? Deepa, how do you think, that can be the solution? Buying more from the US, buying more energy, oil, LNG, etc., from the US, and how much can we do?
So there are options on the table. The reason I say that, this is not yet a complete risk negative scenario for India or for other players in this ecosystem is that one is talks are ongoing. They've not signaled at any point that, negotiations have stalled or that they're unwilling to talk to each other. So there seems to be political appetite on both sides of the government and, of the side to basically keep the talks going and to reach some kind of deal. The energy angle is definitely one of the more recent ones. We have been discussing sort of industrial duties on a few other sectors over the last 2 months, but like the energy angle is new. Having said that, it was something that India had already signaled to the US when, the question was about reducing India's trade surplus vis-a-vis the US, which stood at about $45.7 billion in 2024. So one of the options that India had presented was that, we could continue with more energy purchases. One route is, of course, crude oil, which I think in general, the Indian government would like to diversify their sources. We are very import dependent on that. And of course, given the technical specifications of what kind of grade of crude oil the Indian government is looking to buy, the second is how can they navigate contracts? Some of these are stuck in with long-term contracts. They are not spot buying all the time. But I think the offer or the kind of route that the Indian government might take is purchasing more LNG from the US, both as a way to, sort of signal it as a strategic energy supplier for India and to deal with the issue of the trade surplus is because there are two parts to it. One is Indian demand is also growing up for LNG, and there is more supply coming online in the US when it comes vis-a-vis LNG. So there is a good match the column there, which is happening, which can facilitate sort of that middle route for India. Plus, unlike oil, which is already a diversified pool for India, LNG is mostly, if I'm not mistaken, coming in primarily from Qatar and from Australia. So there is more sort of appetite on the table to diversify that pool there.
Uh, got that. The other bit, of course, is, and we've heard over the last many weeks that these Section 232 investigations will conclude and there'll be tariffs. For example, from a stock market perspective, last Friday, the pharmaceutical stocks all sold off pretty sharply. Pharma is, of course, something which we've heard, not just on the 232, but I mean, even sending those letters to global innovator companies asking them to reduce prices, right? How do you think that sector shapes up, in your opinion?
So actually, Section 232 is the critical bit here. What we've seen so far in the framework agreements that have been announced with South Korea, with Japan, and with the European Union so far, there has been some agreement reached on even lowering those Section 232 rates. And those are where there are a couple of sort of exposures for India, be it the pharma sector or be it the electronic sector. So it really depends on how those negotiations pan out. And it's not just that 25% tariff rate number. So for instance, when it comes to pharma, about 19.8% of India's US exports are just pharma. And same when it comes to electronics, about 12.3% of India's exports to the US are mainly electronics. And the issue there is it's not just about the external signaling and, kind of maintaining that export competitiveness. It's also about domestic manufacturing. So this electronics piece that I spoke of is basically the flagship sort of domestic manufacturing piece of smartphones getting manufactured in India, and India becoming kind of like the smartphone provider both domestically and of the world, especially with the US that we've seen it shift in other policies. So it is those 2 to 3 things which I think are going to be important and they are going to be sticky. So until they have clarity, the kind of impact that you're seeing on the sectors are likely, be it pharma, be it electronics, those two being the most important for India, but also, of course, auto, aluminum, and steel, where we're seeing that the US government is asking for, some kind of duty rationalization and some kind of goods easing. Again, when it comes to medical devices or when it comes to electronic vehicles, it appears to be difficult so far, and the Indian government has not signaled that that's something that they'd be keen to do.
Got that. The although I mean the cost of production for any of this stuff in the US is, I mean, there's no comparison, right? So even if tariffs were to go up a little bit, it's more about competitiveness with competing exporting countries, right, Deepa?
Yes, that is primarily the question, and especially most of those are within Asia Pacific actually. So what has happened so far, what we've seen is most of the deals that have been signed, they have been prioritized within Asia Pacific, where after deals, all India's competitive sort of peers, be it Japan, South Korea, that are somewhere at 15%, and Vietnam, which is at 20%. They're all sub where India is, which is at 25%. This is, of course, with the big signal that India is not having a deal. Now, assuming after a deal, India perhaps goes for that sweet spot somewhere of 16 to 18%, it sort of takes the punch out of that problem, which is, how do you manage regional competitiveness? That regional competitiveness, of course, has other sort of downstream impacts later on Indian GDP and in terms of investment outlook coming into India, especially foreign investment. But yeah, the issue is going to be, where does India sit on that ladder vis-a-vis other Asian countries, especially all of whom are trying to sort of increase their share in the global sort of exports chain? And how does India sort of navigate if in the scenario that they are not in that sweet spot that they're looking at, which is in the low probability, high impact scenario that we have, which is 25% stays on beyond September.
And if it does, you think locally, I mean, the RBI meeting is now, I mean, RBI has, of course, been very, very growth focused in any case. You think the economy will require support?
It would require some support, but I think there are a couple of things to mention there, right? First is we've already sort of rationalized a bit of India's GDP growth forecast for the coming fiscal, rather this fiscal, which is 25-26. It was 6.5%. We brought it down to 6.2%. We've not changed anything since the announcement that was made over the weekend or just late last week. So we are holding at 6.2% now. What is risk positive for India here is that Indian growth is still very domestically driven. So for instance, India's sort of share of GDP when it comes to merchandise exports to the US is only 2%. So it's not directly going to sort of weigh on Indian GDP growth. And as per our calculations that we did earlier in April, at that 26% tariff rate that was announced, it would be an additional cost of 0.5% to the Indian GDP. So there is anyway some kind of slowdown which is happening domestically. This fits into that and it requires support disproportionately. The issue that will happen is it's a bit leaning heavily more on some sectors in India, which is, say, like gems, jewelry, textiles, so on and so forth, which are more labor intensive. So it is about the jobs outlook and it is about the labor security of these industries more than it is about the direct impact on sort of Indian GDP. More medium term, actually, more than the direct impact on Indian GDP, we're more concerned about what it means for global growth slowing down in general. So these are trade destinations that India wants to increase its sort of like trade linkages with, be it the US itself, be it the European Union and other countries in ASEAN. So as long as those GDP growth numbers for other countries look good, it's helpful for India. But if we start seeing more sort of weighing down on global growth, that's where actually the risk increases to the Indian GDP outlook.
Deepa, good speaking with you. Thank you very much for joining us, and I hope we can speak again as this continues to develop. I don't think we've heard the last at all. So appreciate your time here on this episode of the Global Reset. Thank you. We'll take a break here. We'll come back in just a bit from now, and that other conversation coming up. We'll be speaking with Mr. Najib Shah on the other side, and he's of course also watching these developments very, very closely. Coming up. Okay, welcome back. We continue to talk about what tariffs India will get finally after negotiations, which hopefully will continue. Najib Shah is former chairman of CBEC. Mr. Shah, good to have you with us here. Thanks very much. How do you read the latest, sir?
It increases the uncertainty because we still don't know whether this is the final word. I believe too many conditions are being imposed on India. You don't buy oil from Russia, you get out of BRICS, you better invest in US, you better buy from us. I don't think any of these conditions are conditions which we should be accepting with, simply because you can't negotiate from this sort of a position which the US is trying to impose on us. So if our negotiations, which I believe are continuing, lead to something lesser without too many other restrictions or conditions being imposed on us, it'll be great. If not, I think we need to support our exporters through the various schemes which you have got, so that they don't get the competitive edge in the US markets and live in the new world, the world beyond US.
No, absolutely. Mr. Shah, we buy $200 billion worth of oil, right? Import, essentially, 200 plus. The surplus with the US is about $40 billion as of last year. You got to buy the stuff from somewhere, right? So buy 40 billion from the US. I mean, that doesn't really. You think that's that in a way is one of those things you can say, well, look, this is something we're doing, and you wanted to wipe the deficit, is done. I don't know. Is that a complex thing? Of course, price will be a little higher because it comes to you from much further away. That is one. Maybe there are other complexities as well. You've got long-term contracts, etc. You have other suppliers in the Middle East, etc., with who you've got. I mean, but can it be done, in your opinion? What's your sense?
Theoretically, yes. But as a negotiator, one would not like to do that. Why would you want to be subject to restrictions and conditions? And for what? Seriously, if we are going to pay more for that oil, we should not be doing that. The reason why I went to Russia was also because of multiple reasons. We had a long-standing relationship with them. The oil was cheaper. And now it's contributing, what? We get near around 30-35% of our oil from there. Unless we believe that such a step would seriously benefit us in multiple other ways than merely getting access to the US markets, which is what these tariff restrictions are in effect, restricting you from the US market, we should not even be considering it, in my opinion.
We shouldn't be even considering it. And the tonality, etc., is kind of quite harsh, right? That one specific tweet, I think it was Thursday morning or Friday morning, sort of lumping India, Russia together. I mean, it's quite harsh.
Very, very harsh, which is precisely the reason why I believe we should move forward cautiously. And please have a look at the US-EU trade deal which they've had. It is so one-sided. 15% has been imposed on EU. They have been subject to committing themselves to invest in the US. They have been subject to purchasing US energy, and they get nothing in return. So is that sort of a deal we want? I really believe that we should negotiate resolutely. We have been doing so far. We should continue to do so, given only if the consequences are not going to hurt us too badly, and not subject to conditions like don't deal with Russia. I mean, come on. We are an independent country. We have our relationships. Just like US is pursuing its national interest, which it believes will be served by increasing tariffs. So what if the US consumer is going to pay on an average around 15% more on all the imported goods? So what if the trade deficit is unlikely to be wiped off because of this increase in tariffs? But that's their national interest which they're pursuing. We should pursue our national interest, and that national interest demands that we continue our relationship with Russia, we continue to be within BRICS, we continue to do what we are doing, we should do so.
So, sorry, you mentioned one country and you said this is very unfair. Which was that, Mr. Shah?
EU, in the US-EU trade deal.
Yeah.
It's a completely one-sided deal.
Yeah. You know, so absolutely. And when we look at it and you put that table up, it becomes very stark, right? We're 25% plus something on the penalty. Others are 15%, 20%, zero from the other side on US goods, right? But the point is, all these other countries, mostly Japan, EU specifically, they were anyway pretty close to zero. So for them, they were 2.5%, 3% average tariffs on US goods. So for them to go to zero is easier to begin with. Our average tariffs on US goods, I think they stand at about 11.5% or so. So the starting point in that sense also matters, Mr. Shah, right?
It does matter, but I think he's looking much beyond reduction in tariffs for the US imports coming into India. He's looking much beyond that. He's looking at investments, he's looking at purchases, he's looking at commitments. It's not just a deal of reduction in tariffs, which is what we have done, for instance, in many other FTAs or comprehensive economic partnership agreements. It's much more than that. Which is the price I don't know whether we wish to pay. We should be paying.
You know, there is, will this kind of sort of discomfort not force us, but will it become make us more open towards sort of allowing Chinese investments into India, and I mean, at least starting up those visa restrictions, I think went away after about 5 years. Just news came in about half an hour back that, and we'll have to confirm it, but the Adani Group apparently is in talks with the BYD, China's largest car maker, actually the world's largest pure EV maker, to make batteries in India, right? That press note 3 has been, I think, has been relaxed across the board. What's your sense there, Mr. Shah?
Why not? I mean, we should have a coalition of all the aggrieved trading partners of US and see where that takes us. Because there is little reason for us to feel so uncomfortable about what US is doing. I mean, he has been right through he has been focusing on tariffs as the way forward for US. That's a call they have taken, a conscious call they have taken. And I think what we need to do is to see how we can increase our exports to countries other than US, look at the specific sectors which are going to get impacted, support them so that they can become competitive. We have any number of schemes going forward. There are export promotion schemes. We should look at interest subvention. We should look at this remission of duty schemes and support them so that they don't lose their competitive edge in the US markets. Look at other countries who are similarly impacted and see where our common interests lie and pursue that.
Yeah. No, I think we'll have to kind of sort of work this through, right, as as the stocks progress, and we'll see what really happens. Mr. Shah, on agriculture, right? I mean, that's been, of course, the red line, strict no-no. Any thoughts there in terms of what their demands are? And I mean, that's the sticky point, really.
It really is, and it's a question which no government, irrespective of its leanings, will agree to. Agriculture is a critical sector for us. It provides employment. We still have a large rural economy. We need to protect them. And what they are asking for is access to that market. It is a huge market. They are aware of it. And they're asking for access to the market. Why should we agree? They don't agree for our steel imports coming there except after payment of duty. They protect their steel industry. We should not feel shy or run away from the fact that our agriculture industry needs protection. And we should continue to make this a strict no-no.
I think that point's been made clear and absolutely right. No matter which government or which leaning, I mean, I don't think anyone is going to sort of really go there. Mr. Shah, thank you very much, sir. Appreciate you joining us on this program. And we'll continue to talk about this with you as developments come our way, one way or the other. Thank you very much.
Thank you so much.
Okay, well, that's two conversations, and it remains top of mind. We still don't know how this is going to go, but at the margin, some hope that something is going to get worked out. We'll take your leave today. Thank you very much for staying us with another edition of the Global Reset. More coming up on the other side.